the longer inflation stays above target, the worse it gets.
Kia ora, and welcome to the New Zealand Property Market Podcast, brought to you by Cotality for the 20th of April 2026. I'm Head of Research Nick Goodall, and today I'm joined as per usual by Chief Economist Kelvin Davidson. Kelvin, I'm relieved to report first up that there's no major damage for me or our surrounds from last night's torrential rain around Wellington, but I hope everyone out there is okay and has survived from that. There's certainly been plenty of flooding and slips and things, so I hope everyone's all right. Now, we will get to the selected price index data for March later on, ahead, of course, of the Q1 CPI inflation data coming out tomorrow. But before we do go there, I thought we could first cover off your Pulse article from last week. That was delving into our buyer classification data for March, which nicely rounds out the first quarter of the year. So do you want to take us through the key insights that you led with in that article and the conversations you had with some of those journos out there?
Yeah, it was in some ways more of the same, and in some ways, different. And there's definitely that granular insight that we haven't looked at for a little while. So, I mean, first-time buyers still really strong. No surprises there, running at sort of 27, 28% of the market, depending on which month you look at. But when you smooth through those month-on-month changes, still hovering around that 27, 28% mark, which is record highs, and way above their normal position, which is sort of down at 21, 22. So first-time buyers still really active. Same old things, lower house prices, lower interest rates, tapping into KiwiSaver, definitely tapping into the low deposit lending allowances at the banks. That's a huge way in for first-time buyers. You don't need 20%. We say it all the time, but worth reiterating. So first-time buyers still there. I mean, mortgage multiple property owners ticking along around that 24%, 25% sort of mark. Again, changes month on month, but sort of hovering around there. It's pretty much normal for those mortgaged multiple property owners. That's about their long-run figure. Obviously had a tough couple of years when the tax rules were different, interest rates were higher, but those things have shifted around now, so they're sort of back. Yeah, I guess it's kind of a measured return. It's definitely not a boom from those mortgaged investors. It's more of a measured approach, and so yeah, there's things in their favour. Interest deductibility is back to 100%. Interest rates down. That's a biggie. Yeah, those lower mortgage rates mean that those weekly top ups that a lot of people are having to do is those top ups are a lot lower as well by hundreds of dollars a week if on some pretty standard numbers. So that makes a big difference. But there's also challenges. Rents are pretty soft. Council rates are up. House insurance is up. There's I guess concerns about, or some people perceive political risk. Possibly a change of government. Who knows? We might get capital gains tax. So investors will be looking at some supports, but also some challenges as well, and also just this creeping sort of vibe thing that the long run outlook for capital gains might not be as strong either. That you get that sense from talking to more and more people that people are just starting to question that assumption a little bit. So, there's some good things, some bad things, some supportive things, some restraints. So investors are kind of, going middle of the road with that 24%, 25% share. And then movers, the relocating owner-occupiers, they're running about 26%, which is, they're always there. There's always people relocating, but their average is pushing up 28 to 29%. So they're below where they'd normally be in terms of market share. And we've talked in the past about how that seems to be pretty strongly linked to just the economic cycle in times when maybe unemployment's risen, job security's lower, economy's looking a bit sluggish, which is sort of exactly the situation we're in right now. Movers, just why would you move? You stay where you are instead. If you don't need to move, you perhaps stay cautious and stay where you are and put that decision off. So yeah, there's always people relocating, but in general, movers at the moment are a bit quieter than normal. So those are kind of the big picture things. I mean, around the regions, first-time buyers really strong wherever you look. It's an Auckland thing, it's a Wellington thing, but you're going to get in the sort of the smaller towns and cities, and also in provincial areas. So first-time buyers pretty much strong everywhere. Mortgaged investors not necessarily strong everywhere, but signs of strength, say in Auckland. People look at Auckland as an expensive market, but investors are back there, first-home buyers are back. Housing, it might still cost a lot to buy a house in dollar terms, but those affordability measures, which we would have talked about sort of whenever we put that report out a month or so ago, if Auckland does look more affordable now than it has done for quite some time, if you're looking at local houses and on the local income. So So yeah, there's I suppose broad-based strength for first-home buyers. Some pockets of strength for investors. It's not everywhere, but they have come back in a measured way. And yeah, those movers just a little bit quiet, I suppose, waiting for that economic cycle to turn around. So yeah, that's probably the main things.
Yeah, I mean, that's the group I've been talking about for ages, right? Is that we do expect these movers to come back. And once they do, they're going to get the market moving once again because they're operating at a part of the market that maybe hasn't been as active, that sort of middle to upper tier. And so, we keep saying they're just around the corner. Those movers will come back. They've been delaying their purchases, waiting for better economic situation. And that economic situation just keeps getting pushed back further. And so I think so does their activity. So I suppose that just continues on. Yeah, you talked about those investors there. And as you say, it's all relative, right? 3 years ago, things are better now than maybe 3 years ago when they didn't have those regulations in their favour, but they're still not exactly great, or certainly not as good as it was, say, 5 or 6 years ago. So I think it's all relative, but we are seeing them creep back into that market. Certainly you can find pockets of value, but it's not super easy, or just every deal is looking like a sensible deal right now. And I think you've got to reiterate that point that capital gains maybe aren't going to be as strong as forever, and so people do need to make sure they can satisfy the purchase decision and the justification based on at least some sort of decent yield, and not based on I'm going to just hold it for 10 years and ride the capital gains wave up, because we don't think that wave is going to be quite as strong either. So yeah, look, I think those are the key things to mention. As you say, it's mostly consistent with what we've been talking about for the last wee while anyway, so there's not necessarily anything new there to any great degree, but I'll leave a link to the full article anyway. There's a lot more data. You've got actual percentages for many of those centres, even those smaller cities, not just the main five. So do go and check out that detail of some of that, what's happening in your local area. And for some areas as well, you'll see some detail come out this week in the monthly chart pack. I think also when we talk about investors, we talk about what's happening in the rental market, and yep, things are probably not quite, maybe, I was going to say they're not worsening at the same rate they have been previously, not exactly getting better though, but the selected price indices data, which I want to talk about now as well, came out last week. That does go into rents, and again, it just shows that it is a challenging market for those investors. So you do have to be pretty savvy with the property you're buying, and make sure that especially I think for your maintenance costs, or if there's any renovation required, I think you really want to there's going to be a lot more due diligence done from investors these days, making sure that they're just not going to buy a property that they're going to have to sink money into, because it's already costing them a decent amount of money depending on your purchase price, your mortgage payments, and what those mortgage payments might look like in the future as well, right? Now that we're past the trough of interest rates, those interest rate payments could increase in the future. And so you need to be really mindful of that, particularly if you're someone that's looking to go interest only, so you're not necessarily paying down your principal. What are those interest payments going to look like in the future? So yeah, look, there's lots to consider there, and having that detail in the buyer classification data obviously gives us plenty of commentary and insight into what's going on in that market and who's active. And those mum and dad investors in particular, those smaller time investors that have been working their way back into the market, I think the appeal is still there for those buyers to say, yep, I want to buy a property. I can see the physical asset itself. I do expect that it's at least not going to decline in value over time. And so it's going to be able to provide some form of income in future, or if I do get to create equity and pay down that mortgage, that I've got an asset I can sell in the future, realise that capital, and then support yourself off the back of that. If you're not looking to support yourself off the rental payments, for example, and if you've got no mortgage on your own house, then hopefully your own housing commitments are reduced and you can survive off that. So that still is appealing, I think, for many people. Again, probably not quite as strong as appeal as it was in the past, but it still does exist. But yeah, anyway, move us on to that selected price indices data, Kelvin. As I say, the rent data is within that, but I think more attention is going to be paid to what we're paying for petrol and food and airfares and all those other things, because we've got the Q1 CPI inflation data out tomorrow. Now, of course, this is for March, so it's not the full quarter, but it is the month that we know was, basically fully affected by the war in Iran. And so it gives us a feel for, depending on how long this thing goes for, what genuine impact we might see longer term to the likes of petrol prices, and then the impact that's going to flow through to CPI inflation data for Q2. But yeah, anyway, mate, take us through the key insights from that release and the implications you think it's going to have on broader inflation, and then eventually the Reserve Bank's decision about what to do about that. So yeah, back to you, mate.
Yeah, I mean, just to finish off on the buyer classification, one thing I was going to say, there's a chart in there of the breakdown of mortgage multiple property owner activity. So, I mean, you touched there on the sort of cliched mums and dads. We actually got a chart in there that shows that breakdown, and that okay, as I say, it's sort of a measured comeback by investors in general, but underlying that, it is the smaller players, the so-called multiple property owner two that we talk about. So that's somebody who after their latest purchase now owns two properties. So it's as opposed to say an MPO 10, I think we have in there, MPO 4 to 5 and 10. So it's sort of that smaller end of the spectrum. It is maybe your new property investor, your cliched mum and dad, someone who's taking a little bit of equity out of their own place and using that as a deposit, that sort of thing. That's where that comeback by mortgage investors has really come from. So, and I think for them, it's those top ups that's going to be the really visible thing. And when interest rates come down, yep, a lot of people will still be putting money into these properties, but it's just real. You can talk about tax rules, that sort of thing, but you only pay your tax once a year. What you're doing every week, every month is topping up that mortgage. And so when those interest rates come down, it's so visible for those mums and dads, the cliched group. When those top ups come down, that changes the mindset as well. So so I think that's a big factor for them, and that's what's driven up that overall MPO line. But in terms of selected prices, so monthly data, and it covers about 45% of the benchmark quarterly CPI. This is the monthly selected price indices measure, and it sort of relates more to the so-called tradable stuff, the more volatile elements. So it will tend to be a bit more up and down than the sort of benchmark quarterly CPI. But yeah, it was, and as you say, it only covers 1 month of that first quarter, but it was, we're definitely seeing the impact start to come through. I mean, petrol prices up, sort of pushing almost 20% in the month. Diesel up more than 40% in the month. International airfares were another category that went up quite a lot as well. So yeah, there's no surprises there. We knew those items were going to be up pretty substantially. I suppose overall, the general feeling on the selected price indices measure is that it wasn't, even with those big increases for fuel in mind, some of the other things perhaps weren't as bad as what we might have otherwise expected. So overall, it was, I mean, not a great number by any means. There's still obviously that volatility in fuel prices, but the other elements weren't perhaps quite as bad as what people might have anticipated. So sort of feeds into this wider idea that Q1 CPI, when we get it on Tuesday, will be sort of not too bad, if you can sort of use that phrase. It's kind of the calm before the storm is what people are sort of talking about. That the Q1 CPI number might not be horrendous. It might have even come down a little bit from Q4, but we know that when we get April, May, June, that it's going to look a lot worse. So yeah, there's kind of, people might see the latest inflation numbers go, oh, that's not too bad, is it? But we know there's more coming, and there's sort of more on the pipeline. So and obviously those petrol and diesel prices up a lot, which is Reserve Bank's concern. That's going to feed through to the indirect first round effects and then the second round effects, which is when people start to push up their inflation expectations and maybe with their wage demands, that sort of thing. That's what they're really, really vigilant to, which is their phrase. So, I guess, in terms of what it means for the Reserve Bank, it's, they'll obviously be watching the numbers. The Q1 number itself for CPI might not be so bad, but, they fully anticipate, I think they projected that the Q2 number might be up above 4%, and, potentially going higher again if these fuel prices stick around. So, yeah, it's probably one of those things, we're still in watch and wait mode. If anything, it seems that the tone of the commentary from commentators, from bank economists, is maybe just creeping forward ever so slightly. It's always this creep forward, with people talking about, well, the first OCR increase won't come through till September. Maybe now it's coming forward a little bit from their side. And it's not necessarily like things have necessarily changed, but I guess it's just this, the longer inflation stays above target, the worse it gets. Even if you still believe in spare capacity, even if you still believe in, we're watching, we're waiting to see these second round impacts come through, that might not come through for a while yet. It's still a bit uncomfortable. They've got one target, they've got to keep CPI within that 1 to 3% band. The longer it's outside that band, even if it's for explainable reasons, it's still just a little bit uncomfortable. And maybe that's, I suppose, the tone of the recent commentary is that might just play on the minds of the Monetary Policy Committee, and they just sort of can't wait any longer, I guess, seems to be the tone of some of the commentary. So, yeah, it is this calm before the storm sort of environment we're in, I guess. We're starting to get that flow of economic data coming in for March, coming in for April, and it's, starting to look a little bit worse. So, So yeah, it's all a little bit uncomfortable. Just quickly on property rents, the selected price indices measure also has property rents in it, which I mean, they're a bit jumpy. Seems to be something going on with these numbers. They sort of surge up and then they're back down and then they're up again. Whether there's a measurement thing going on or a processing thing, I'm not quite sure. But there's maybe hints in these rent numbers that they're starting to reach a floor. But and things going on in the economy. We know migration's up a bit. Looks like rental listings have come down a bit. So you could kind of start to explain a floor for rents if that's what we're seeing. It's pretty tentative, and I would be just a little bit cautious because, on the other hand, as I say, the numbers are pretty jumpy at the moment. So you wouldn't necessarily want to just see one slightly better number and go, oh, it's all over, floor for rents. That they are a little bit jumpy, and also the fact is rents are still very high in relation to incomes. So even if they have flattened out, are we going to see the start of a new upturn? That sort of seems unlikely too, because tenant affordability is pretty stretched. So yeah, maybe there's hints in the latest rent numbers that they're approaching a floor. Would I go overboard? Probably not, because the numbers have been a bit jumpy and rents themselves are still quite high. So. But from the Reserve Bank's perspective, at least, there's not much inflation coming through from the housing market anyway. That's one thing they don't necessarily need to worry about. Lots of other things, but at least the housing market, from their perspective, is not really a source of inflation at the moment. So, yeah, that's kind of my take.
Yeah, I think on the rent side too, like we've got to recognise this is most of the data is a few months old as well. It's still again likely before all the uncertainty it's been caused by Iran as well, and who knows what happens to migration, going forward because there's more uncertainty just means people don't look beyond. And again, if our economy is going to be worse, fewer jobs creation, then why would people move here if they can't find a job? So, I think that, any turnaround or any, like say, trough that things might have got to, I think, we're still got to have reason for pause, I suppose, as to thinking it is a big change because there's this massive disruption which has occurred over the last 6 or so weeks, which might influence where things go from here. So I think there's another reason for just being cautious around that one. On the inflation data, I suppose just trying to summarise the response from that at the end of last week. I think, I saw some of the economists talk about, well, if you just look at this 1 month, and then if you assume that what happened in March continues to happen for all of Q2. Let's just say that as an example, right? And that's maybe not out of the realms of possibility, given it appears, again, things are changing daily, that the strait is once again effectively closed, and who really knows what to read? There's a massive, tweet from Donald Trump overnight that I read this morning. And so it's just so hard to know when this is going to end, the true impact to getting diesel and gas flowing around the world again, that if we do see what inflation occurred in March continue to occur for, let's just say, all of Q3, that, it's not a crazy situation to say that our overall CPI inflation figure for Q2 could be up at 5%. Now, if it is, or above 5%, what's the Reserve Bank going to do? Because, as you said, even if they're trying to look through these impacts and they say it's short term, and once it gets back open and we get, full, ships going around the world again, and hopefully we get back to some level of normality, like it's still going to take some time for that inflation to drop back to that 1% to 3% band. So are they likely to have to do something about it? Even though they know it's going to be a detriment of the broader economy and it's going to demand a destructive more demand in the future. Like, they're going to be in a pretty tough position, right? And I think we've sort of seen this play out a little bit last week, where we saw ANZ economics team say they did expect to see an OCR increase in July. You saw Kiwibank's economics team push back pretty strong on that and say that would be the worst thing to do. So it's just, it's a pretty crazy, terrible use of terminology here, but it's a minefield of stuff that's going on, right? And both reads from ANZ and Kiwibank, I can absolutely understand both of them. And it just shows what difficult position Kiwibank are going to be in. At the moment, we're all having to speculate on what figures they're going to be dealing with in July, which is a difficult thing to do at the best of times, let alone right now. So it is all speculative. We don't know how long it's going to play out. We don't know the genuine impacts to inflation. We don't know how much that inflation will stick around for. So it is all speculative right now, but all of these scenarios are absolutely on the cards. And I think that just illustrates how difficult a position it is, and it's going to be for the Reserve Bank right now, not just now, but in those future decisions as well. And for those markets or those economics teams, and they're no doubt impacting the pricing teams within those banks as well, for them trying to decide what they do with mortgage rates, because they're saying, well, where are they going to be in 6 months' time? We need to have some sort of expectation on that. And there is this diverging situation right now between those swap rates and the OCR forecast as well. So look, there's plenty there. I don't profess to have all the answers at all. I think that, as we often talk about, you can have these forecasted scenarios and there's going to be upside and downside risk to both of them. It does just feel to me that, and maybe it's just a pessimistic view, but yeah, the upside risk to interest rates, seems pretty strong, I guess. And that I suppose the way of saying that is, yeah, it seems to me that, while we can hope and expect that the second round impacts aren't as great, and the Reserve Bank will be mindful of, even worse affecting the economy down the track, and that's fine to hope that we're not going to see those major OCR increases until September at worst. I think there is some definite upside risk or some early side risk to that happening sooner. Certainly not saying it should happen or it's the most likely outcome, but we have to be mindful of those things because, the longer this drags on, the worse inflation is going to be, and the more sticky it's going to be, the longer it's going to stick around, the more the Reserve Bank is just going to simply have to do something about it because, as we talk about pretty much every week, their one target is inflation. We know that's pretty much the worst thing for all economies is to have higher inflation for longer. So you got to do something about it, even if it is going to affect the broader economy. So yeah, tough position to take. Certainly a pessimistic view probably to touch on, but that's probably where my head's at the moment. And no doubt, in the next few days or few weeks, we'll see things change again, and maybe we can take that optimistic view again. But for now, that's kind of where my mind's at. So yeah, not a great one, but that's where it's at. Feel free to take us any other place you need, Kelvin. Glad you touched on the migration data too, obviously, which did see, further growing migration into the country, which is obviously a good news story. Just to touch on what else is out there, our monthly video is live. So again, I think it's sort of 4 minutes or so long, trying to summarize the situation with a few visuals, and you can see some of those charts. So I'll leave a link to that. So do go check that one out on our YouTube channel. I know our chart pack is out this week, touched on that earlier. That'll be live on Thursday. So again, great amount of detail there on all of this stuff. By classification, yes, but sales volumes, and we can talk about that next week probably, where March ended up with sales volumes, and kind of the Q1, because I think it wasn't quite as strong as we expected. But yeah, is there anything else on your mind to wrap up the last week, Kelvin? Otherwise, anything else that you're looking ahead for this week?
No, I think that's pretty much it. Yeah, chart pack will be out on Thursday. I think I'll probably be touching on the sales as a sort of key point, as an executive summary, kind of lead chart. It's been a sluggish start to the year, and maybe the first month you could kind of say, well, it was activity pulled forward into December, but yeah, it's just been lasting, and largely these figures even predate the whole Iran conflict, so it does seem set up for a kind of pretty soggy sort of start to the year for sales. We've already had January to March. It's been pretty soft, and seems like that could linger. So yeah, activity's just looking a bit soft. So I think that'll probably be the focus of the start of the chart pack, at least, as well as all the other detail that goes in there. So no, I think that's about it.
Yeah, I think we'll delve into some of those details regionally as well. Look at how some of those sales are tracking. I've been showing a longer term chart to see, where the last year or two sales volumes compared to even a decade ago. So I think that's some interesting context. We can tease that out next week. But that'll do us for sort of property and economic data for today, Kelvin. So yeah, if that's your lot, then please do leave it there, and we'll catch you all next week. But briefly, on a personal side thing, Kelvin, I know that you headed up to Hamner over the weekend. How was your weekend up there? And I can talk more about dealing with the rain here in Welly.
Yeah, no, Hamner was great. It was we love going up there. Kids love it. It's the weather was okay on Friday, so we managed to get out a little bit. It sort of packed in a little bit Saturday, Sunday. Not as bad as elsewhere around the country, but yep, and it doesn't necessarily matter because the hot pools are the big attraction in Hamner, so you can go there whether it's fine or wet. So no, it was great. Got to say, it was maybe a little bit quieter than I thought it would be. I mean, it's the last week of school holidays. Maybe people have already left, but maybe it's an anecdote about fuel prices, people delaying their holiday plans or putting off their holiday plans, staying home instead. So just wonder about that. Could be correlation, not necessarily causation, but yeah, you just wonder whether that's a wee anecdote of people staying at home rather than going away. So, but it meant it was quieter. You didn't have to wait for the hydro slides, so that was a good win for us. But no, yeah, and we've largely avoided the weather so far. Sounds like Wellington's been hit pretty hard.
Yeah, that certainly was crazy last night. Certainly, I've seen plenty of photos and videos of the damage around the city and some of the flooding that was occurring overnight. But hopefully, most of it subsided, and yeah, the emergency services can get in and clear all of that. But yeah, that's pretty tough. And yeah, so no football for me on Saturday. It was cancelled. So after me complaining last week about it being too hot and that it wasn't even it's supposed to be the winter football season, and I know it's not quite winter yet. Certainly, karma got me this week, and yeah, the weather packed in, and we got no football there. So that was tough, but just been with some family time and went to the movies with the kids and things. So yeah, and I had my birthday last week, so got a bit of birthday time as well. Went out for dinner and things. So that was kind of a birthday weekend, I'd call it. So that was nice. From a sports perspective, yeah, Phoenix, look, they won, but they are done. They're out of the finals. 1 week to go and still out. There was a little bit of hope when the Raw were beating Melbourne City for a short period of time, which meant that yeah, if that played out, we might have had a chance to win next week and then jump into the six. But that's got done because City ended up coming back to win that one. So Phoenix are done for the season. I did see a thing that talked about if the points per game that the Phoenix have got since Chris Graniger took over, they'd be top of the table if that was for the whole season. So they have to give Creaney the job full time. So hopefully they do that for next year. And another thing to mention was the blockbuster up in Hamilton between the Chiefs and the Canes going extra time. Chiefs getting it in extra time there. I did kind of expect that to happen, so it wasn't too downcast from the Canes not winning that one. And maybe that's a preview of the final later on the year, hopefully here in Wellington though. So yeah, looking at that one in the calendar, it might be another good one for the final. But yeah, otherwise that was pretty much it for my weekend, mate. Anything else before I close us on and get us out of here, Kelvin?
Just to say, it was pretty lucky for the Chiefs at the end, wasn't it? I mean,
Yeah.
that doesn't happen every day of the week. Now, they might have won anyway if it had gone a little bit longer, but, well, that's, that was a bit of luck. So, great game. I mean, yeah, worthy of a final.
Yep, they're in position to get that luck, I suppose, and yeah, quality players will find a way. But yeah, all good, mate. We'll leave it there. But thanks as per usual for your thoughts, Kelvin. Appreciate your time every Monday. But also, thanks very much for listening. Please do get in touch with any questions or feedback. Always appreciate hearing that. But that'll do us for today. My name is Nick. He's Kelvin. You've been listening to New Zealand Property Market Podcast. Mā te wā.